Hey everyone, this is Patrick Donohoe, and in this video, I'm going to be teaching you about compound interest. The title is Dissecting Compound Interest. So I'm going to teach you three things. First thing is, what is compound interest and how does it work? Second is why using the compound interest equation when it comes to projecting the future results of an investment may not always be as accurate as you think. And then the third thing I'm going to teach you is the impact that fees and taxes have on the future results of this compound interest projection. So let's get started. So Investopedia describes compound interest as a principal sum of money that earns interest, and then that interest earns interest. Now, if you look at a long time frame and a fixed rate of growth, it's pretty remarkable what compounding can do to just a small sum of starting principal. So let's go ahead and take a look. So for those of you who are familiar with compound interest, you've probably seen something like this before, which is the hockey stick example. So if you look at just a very simple graph, and on this axis we'll say that going up is more money, and then on this axis we'll say that the increasing amount there is more time. So in the beginning, when you're analyzing the growth of interest, there's not very much growth. You're kind of starting there, but then things start to really take off toward the end. So right about here. So it is a pretty good way into the amount of time it takes, but once you hit that period of time, then the interest takes off. So this, of course, does not look like a hockey stick. A hockey stick is more referring to a really long period of time. So I'm going to actually show you an example using numbers now. So let's say that 100 years ago, you had a relative. Let's call them your great-great-grandmother, and they deposited $1,000 into an account, and that account was earning 8%, but it only could be touched until 100 years in the future right now. And you coincidentally are around and get to have whatever this amount of money has turned into. So I'm just going to use a smaller, interest rate, 8%. And I'm going to use that $1,000, which is what your great grandma deposited for you. So let's see what happens. In the first couple of years, not really much to scream about, but look at what happens over the course of time. Just like that point in the compound curve, you start to experience it here, right around the 50s and 60s, where look at where the interest is going. And ultimately, toward the later part of that 100 years is really where you see tremendous growth. And you actually wind up with $2.2 million. Now take a look at 2009, which is we're going from 1920, so that's 89 years. So even at like about 90 years, okay, you double money in just that period of time until the end, 2019. So there's tremendous growth right at the end of this 100 years. So, and I'm sure you wouldn't complain about having $2.2 million if that in fact is what your great grandmother did for you. Now let's talk about the idea of fixed rate growth and how that relates to a market-based investment which is not fixed. So as you can see here, this is a 30-year history of the S&P 500, a popular index that's used. So it goes from 1989 to 2019, and if you look at all these different years, you had some little losing years, but look at the big gaining years: 27%, 34%, 31%, 27% again. Pretty big gains. But look at the losses. You have small losses here, but look at the dot-com crash, right? 2000, 2001, 2002. And then look at the 2008, where we had, the financial crisis. So you ultimately have, a 9.6 return, which is these 30 years of yields divided by 30. Now, this is really where it gets interesting when it comes to financial planners, typical financial advisors, and the projections they make about what your wealth is going to accumulate into in the future. And this is where it's not entirely accurate because they are using the 9.06 to project what the gain will be in the future. But this is where there's a probability of loss, okay, you essentially kind of reset the compound curve. So let me show you what I mean. So let's look at 2008. So in 2008, as I just showed you, there was almost a 40% loss in the market. So I'm going to put in there 40%. Now the market did rebound. And if you look at the rebound, this is where things get pretty interesting. So with math, right, if you just looked at the average of what the returns would be over the course of 2 years, in order for the index to get back to break even, okay, all you have to do is gain 40%. So let's put in 40% there. So if you have a negative 40 and it rebounds by 40%, and you get back to an average return of 0, you get back to break even when it comes to the percentage. However, when you add numbers to it, so let's put in there a $100,000 portfolio, okay, now this is where it shows how using an average return and then using actual performance are two entirely different things. Because here, if you lost 40%, your portfolio goes to $60,000. So if you go to $60,000 and you earn 40% the next year, that's only $24,000, not 40. So you're not back to break even though the average return says you are. So this is really important. And now let's go ahead and look at the 30-year average return in the S&P 500. And then let's look at what the actual performance is. So this right here is going to show you between 1989 and 2019, if you earned an average of 9.06% per year, and let's say you had a portfolio of $100,000, then you are going to essentially accumulate $1.348 million. Okay, not bad. But now let's actually paste in the actual performance. So instead of having the 1.348, you now are down to $902,000. You can see that there is some pretty significant losses when it comes to the .com crash as well as the 2008 financial crisis. So now you have, essentially $400 and almost $450,000 less than what you would have at an actual return of 9.06%. So the actual return is 7.61%. Now, here's what's also interesting. If you invested on an ongoing basis, let's say $10,000 per year, instead of 7.6%, you're now going to have 6.5%. So when it comes down to the idea of compound interest, and what I hope you're learning from this is when the typical financial planner, financial services professional is projecting out in the future, there's a reason why they are required to disclaim that future performance is not indicative of past results because of what you're seeing here. But nonetheless, they still use these average returns to project out what things will be, which is not entirely accurate. So let's go ahead and end with the third thing I'm going to teach you, which is the impact that fees and taxes have on overall performance. Now, investment fees have definitely gone down. Technology has enabled a lot of efficiency when it comes to funds, specifically exchange-traded funds, ETFs, mutual funds. You have no-load ETFs. Vanguard was paramount in really putting forth the low-cost funds. So even though they've come down, let's still use a conservative fee structure, which is about 1.5%. So if you use average fees of 1.5%, you can see that brings the actual return down to 4.95%. Now, taxes is another interesting thing because the investments that you have are going to be taxed differently depending on where you hold them. If you hold them in a 401k or an IRA, then there isn't going to be any type of annual tax. The tax is going to be when you withdraw in the future. If you have outside of a qualified plan, if you have your investments, just they're taxed normally, it depends on the actual investment. ETFs have some ways in which they're taxed. Mutual funds have different ways in which they're taxed. So let's just use a tax bracket of long-term capital gains, which is for most people 15% right now. So that 15% long-term capital gains, okay, puts you at about 4.37%, $623,000 as the end balance. Now remember, what was projected was the average return, 9.06, which gave you $1.348 million. Going to $600,000, you're now about a little over almost over $700,000 of opportunity cost that's lost. Okay, because of not taking into consideration how the actual numbers work out in the end. So hope you guys have learned a little bit more about compound interest, and it's enabled you to ask better, be able to ask better questions when it comes to investment advice that you're given. So if you like what you've heard, if you have any questions, if you don't like what you've heard, comment below. I'd love to hear from you. I'd love to hear your questions as well. And I'll definitely respond to those. Also, subscribe to this YouTube channel. So all the podcasts that I do are on here, most of which are done in video. And I also post other tutorials. So love to have you guys, love to have the support. All right, thanks for watching today. We'll see you later. Bye.